Here's something that'll blow your mind. The pace at which your favorite AI company builds the next generation of artificial intelligence is no longer determined by brilliant engineers or clever algorithms. It's determined by interest rates. Yeah, you heard that right. The bond market, that thing your grandpa watches to understand savings account earnings, is now the gating factor for AI development across the entire tech industry. Why? Because building AI infrastructure costs mind-boggling amounts. We are talking about trillion-dollar capital expenditure over the next few years just to manufacture and deploy all the chips and data centers this technology requires. And here's the kicker. Most of that money isn't sitting in corporate bank accounts. Tech companies are going to the debt markets, issuing bonds, and borrowing hundreds of billions of dollars. Which means when the Federal Reserve raises interest rates or when global uncertainty spikes bond yields, suddenly it becomes way more expensive for Nvidia, Meta, Google, and OpenAI to borrow. And when borrowing gets expensive, CapEx budgets shrink, GPU orders decline, AI development slows. The entire velocity of AI progress is now hitched to a financial variable most tech investors haven't thought about since 2008. So let's set the stage. Over the past 2 years, tech companies have gone absolutely all in on AI infrastructure. We're not talking about incremental increases in CapEx. We are talking about a complete change in how these companies allocate capital. Nvidia's data center revenue has exploded to tens of billions of dollars per quarter. But here's the thing, Nvidia's the supplier. For companies actually building the data centers, Meta, Google, Amazon, Microsoft, OpenAI, the cost structure is brutal. A single training run for a large language model can cost tens of millions of dollars. A single data center can run multiple billions of dollars, and these companies don't build just one. They're building dozens. Some estimates put the total AI infrastructure capex across the industry at $1 to $2 trillion over the next 5 years. 1 to 2 trillion. That's more than the annual budget of every federal government except the United States and China combined. So here's the reality. Even megacap tech companies with hundreds of billions in cash can't fund all of this from operational profits alone. They need debt. They need to issue bonds. They need to borrow at massive scale. Here's how the math works. When a company wants to borrow money, it doesn't just go to a bank anymore. It issues bonds, essentially IOUs that it promises to repay with interest over a set period. The interest rate on those bonds is determined by market conditions. If the economy's doing well and inflation is low, interest rates are competitive. Companies can borrow at, say, 3 or 4% per year. But if the Federal Reserve is fighting inflation by raising rates, or if global economic uncertainty spikes, suddenly bond yields jump to 5, 6, or even 7%. Now here's where it gets interesting. When a company borrows $100 billion to build data centers and the interest rate is 3%, it's paying $3 billion per year in interest. But if that rate jumps to 6%, it's suddenly paying $6 billion per year. That's an extra $3 billion annually that could have gone into more GPUs. More chips, more infrastructure. Multiply that across the entire industry and you're talking about tens of billions of dollars a year in additional financing costs, which means less capital available for the actual build-out. The bond market isn't a side concern anymore, it's critical. Let's look at concrete examples. Meta's already announced plans to spend something like $60 billion this year alone on AI infrastructure. That's not money sitting in cash. That's borrowed money, issued bonds, and operational profits all combined. If interest rates stay elevated, that effective cost goes up significantly. Google is doing similar things. So is Amazon. Microsoft is investing heavily in its partnership with OpenAI. All these companies are issuing bonds at record levels. In fact, if you look at tech sector bond issuances over the past 18 months, the numbers are staggering. Tech companies issued more debt in the first half of 2026 than in any similar period on record. Now, these companies are sophisticated. They're calculating that the return on AI infrastructure investment will exceed their borrowing costs. But here's the key. That calculation has a break-even point. If interest rates spike too high, if the return on infrastructure investment isn't what they expected, or if there's a recession and bond yields spike even higher, suddenly that calculation flips. When the math breaks, CAPEX plans get reassessed. And when CAPEX plans change, the entire velocity of AI development changes. Now you might be thinking, this isn't new, big tech companies always borrow money, and you're absolutely right. But here's what's different about the AI era. In past tech cycles, dot-com, mobile revolution, cloud computing, the CAPEX requirements were significant, but they were also more dispersed. Hundreds of companies competed, experimented, built different platforms. The capital needs were spread across the ecosystem. But AI is different. The infrastructure requirements are so enormous and so centralized that a small handful of mega-cap companies are consuming the majority of global CAPEX available for tech infrastructure. We are talking about Nvidia, Meta, Google, Amazon, Microsoft, Apple, maybe a handful of others. That concentration means their financing decisions now move the entire bond market. When these companies issue bonds, they're moving interest rates for the whole economy, not just their own borrowing costs, which means a decision by one mega-cap CEO to ramp up AI CAPEX potentially affects interest rates for everyone else. It's a coordination problem on a massive scale. And here's what most people are missing. Nobody's really talking about how centralized this risk has become. So here's what all of this adds up to. The speed at which AI develops is no longer purely a function of algorithms and talent. It's now also a function of macroeconomic conditions and Federal Reserve policy. If the Fed cuts interest rates and bond yields fall, suddenly AI CAPEX becomes cheaper to finance, and companies accelerate their build-out plans. If the Fed raises rates, or if there's a recession and bond yields spike, you'll see CAPEX plans get reassessed and the pace of development slow down. This is profound. It means decisions made by central banks in Washington, D.C. and Frankfurt are now directly impacting how fast artificial general intelligence gets built. It means bond traders on Wall Street have, indirectly, more influence over the trajectory of AI than most people realize. It means if you're an AI investor, you can't just pay attention to the usual tech metrics anymore. You also need to watch bond yields, central bank policy, and inflation expectations. The AI story is no longer just about innovation. It's about capital and economics and macroeconomic cycles, and that's something worth understanding right now. Let me give you a practical framework for thinking about this. First, track the 10-year Treasury yield. This is the interest rate the United States government pays when it borrows for 10 years. Tech companies use this as a benchmark for their own borrowing costs. They typically borrow at a premium on top of Treasury yields. So when the 10-year Treasury moves from 3% to 4%, you know tech companies' borrowing costs have risen too. Second, watch tech sector bond spreads. This measures how much extra interest tech companies have to pay compared to the government. If spreads are widening, the market is getting nervous about tech borrowing. Third, pay attention to Federal Reserve policy signals and inflation data. When the Fed is raising rates, bond yields typically rise and CAPEX becomes more expensive. When the Fed is cutting rates with low inflation, bond yields tend to stay lower and CAPEX gets cheaper. Fourth, listen to what megacap CEOs say about CAPEX plans on earnings calls. If they start qualifying statements or saying things like we're going to reassess returns, that's code for interest rates are affecting our calculations. These signals matter. They are telling you the bond market is influencing AI investment decisions. Here's what you're supposed to take away from all of this. The AI build-out is real and it's massive and it's going to continue. But the pace of that build-out is now constrained not just by technology or talent, but by capital markets and central bank policy. Which means if you're investing in AI, if you're paying attention to the AI story, you need to expand your mental model to include macroeconomic factors. Watch the bond market. Watch Federal Reserve policy. Watch inflation data. These aren't peripheral concerns. They're now central to understanding how fast AI will develop and how much value AI companies will actually create. This doesn't mean the AI story is dead or that you should sell your positions. It just means the story has become more complex and more interesting because it's no longer just about innovation. It's about economics. It's about the interplay between central banks and corporations and capital markets and technological progress. The next chapter of AI won't be written just in Silicon Valley. It'll also be written in the bond pits of Wall Street and in the policy decisions of the Federal Reserve. That's the insight you should be paying close attention to. Follow for daily AI news that digs deeper than the headlines.